what I always joke around with when those patterns are building out. One man's double bottom is another man's H pattern. A double bottom is a bullish pattern. An H pattern is a bearish pattern. It's called an H pattern actually out of the lowercase h, not the uppercase h, because it looks like kind of like the lowercase h, right? Like it comes down hard, you get like a rounded bounce, and then it comes back down to the support where it first pivoted. And then again, it's really a downtrend. One pattern, double bottom, is a reversal pattern. Your H pattern is actually a downtrend continuation pattern. So again, little quick half step back. In technical analysis, there are only two types of patterns, right? And everyone's raising their hand up. But what about head and shoulders and cup and handle and bull pennants and bull flags and this, that, and the other, and scoop pattern? And I think I just saw Rich say, I've never heard of that before. I'm sure that if you ask Pat knows like 5,000 more patterns than I do. But all there are reversal and continuation patterns. A bull flag is a continuation pattern. An H pattern is a downtrend continuation pattern. A double bottom is a reversal pattern. A head and shoulders is a reversal pattern, right? And this is why, if you're going down to the fundamentals of technical analysis, the fundamentals of technical analysis include an understanding of trend at the root of everything. Because again, continuation pattern, reversal pattern, what does that mean? Trend continuation or trend reversal. Higher highs and higher lows, lower highs and lower lows. That is the root of all technical analysis right there. So an H pattern is basically a continuation pattern where it kind of looks like the lowercase h, right? You see it coming straight down here, and then it kind of bounces and rounds and comes back to that support area. And if it breaks that first support area, well, then you got your H pattern. You got downside continuation where you are then expecting, this just becomes the next bigger picture. The top of the lowercase h becomes the next bigger picture lower high. And you're in a pattern of lower highs and lower. This was the lower low, lower high, comes back down, but breaks, lower low, maybe it comes back up and retests 80, lower high, etc. You especially see that H pattern, I find, on like 5 and 15-minute charts on downtrend days. Like find that next day where the SPY trend's down all day. I can promise that you'll find some H patterns in there. Now, double bottom is a reversal pattern. Right, double bottom is when you're going from a pattern of lower highs and lower lows to a pattern of higher highs and higher lows. So basically what happens at double bottom, a double bottom looks like the the uppercase W, but I guess this font doesn't do a good job. It's like the uppercase W where, it only goes up halfway in between. I could draw it on a board, it's like bam, 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 bam. Kind of like your uppercase W. So, you're coming down into that support, it finds support, it bounces, it comes back to that same level, it holds it, breaks up. Now, your double bottom is only actually confirmed when the midpoint of the W breaks, right? You can almost see here that how this, if this continues higher, will look like an uppercase W. So technically, you only have confirmation on double bottom in the case of Lemonade here. There's a lot of other stocks that look like this right now if it gets back above 113.17. That is the patterns there. And honestly, why I always say, half jokingly, one man's H pattern is another man's double bottom, is because when this thing is first testing 80 here and first testing this low, you don't know which it's going to be. You don't know, right? So you pay attention to your level. If you were buying Lemonade off of 80, which is a trade that I love, and it holds, and you get this bounce back, well, maybe this becomes a double bottom and you have reward potential. If this is a double bottom, technically, it should give you $23 worth of reward above 113. So what's that? To 136, I think. So technically, anyone who's long Lemonade from $80, which is an idea from yesterday, you have reward potential to 136. So if your risk is covered and you book some profit, this is when you become greedy from a game planning perspective, right? You're never going to catch a move to 136 in Lemonade if you're long off 80 and you get out at 81. It's never going to happen. And again, this is where, from a game planning perspective, that overwhelming reward comes from that actually really pays you the big money. How often do you need to buy Lemonade at $80.50 with 50 cents risk and catch a move up to 136 to be a profitable trader month over month? You don't need to capture that very often. If you can capture that once in a while, you're doing really well for yourself. So what do? You put yourself in the position to be able to make that all the time. And that's where you come into that concept of intraday risk for daily chart reward that we were talking about